I just thought I'd take a couple of minutes to put some of the recent share market events into a bit of context. So here's what some of the headlines I read said. Global financial crash may be imminent. US stock market has its worst week in 2 years. Now I totally understand why the newspapers run with these headlines. Bad news sells. But as an advisor and an investor, here's what I would have liked to have seen. US stock market has increased on average over 21% for the past 5 years. Put another way, if you had invested $100,000 on the 1st of January 2013, you would now have a little over $250,000 in your account. Now, those aren't the sorts of things you're going to read on the front page of the newspapers, but as investors, I think those are the sorts of things we really should remember. Let's have a quick look at volatility and what it means. An absence of volatility in an investment means you're unlikely to get a higher rate of return. Owning part of a business, which is really what investing in the share market is, entitles you to a part of that business's future profits. So while the price of a company may bounce around on any given day or in any given week, in most instances, the future profits that company expects to make don't vary significantly on a daily or a weekly basis. Now, nobody likes market declines, especially when they're of a reasonable size, but the reason companies have historically provided a higher rate of return than bank accounts is due to that very volatility, that uncertainty or that risk in knowing what the price will be tomorrow. If we, as investors, can accept this volatility, then we can continue to expect a higher rate of return by owning companies than having money in a bank account. So I hope that makes sense, and we as a business will continue to be monitoring the events of share markets, and if there's anything permanent or significant, we'll be sure to be in touch with our clients.